What's happening all? It is early again, another week where I have to do it even earlier than normal. Sun barely starting to kind of come up out there. It's interesting how the camera picks it up way better than it looks. But it is the 19th of January, Friday. I got a crap ton of stuff happening this morning. So this is not going to be a real fast one, a real long one. I'm going to make it quick, and it might be a little bit of a rant too, but I want to show you this, guys. Everybody keeps asking what the rates are. Quote the rates, quote the rates, quote the rates. Of course, I take them, go to bankrate.com, go there. That's what it is. Scroll down. You'll see the little girl on the yellow slide. See where a better rate is waiting. Click on mortgage. 30-year fixed, 7.06. This is where people buying a house to live in. I work with real estate investors. They're freaking out. Why are we not in the sixes? Guys, the market's not there yet. In fact, I don't know that it's going to get there. So let's look at another thing that we continue to keep showing. See here, another share screen. Let's look at this. Okay, so this is mortgage-backed securities chart that we show to kind of illustrate where the market's going. Now, for those of you who have not seen this before, every single one of these marks here, these what they call a candlestick, represent a day's worth of trading. In this one here, this is the lowest day we had seen in the market since 1996, I believe. I could be a little off on that. But right here shows where the market started, where it opened. Little tiny wick where it went traded down just a little bit, where it went all the way up here, a little bit higher wick, and then settled back down at this point, meaning money flowed into this security that day, bringing in money in, bringing interest rates down to supply and demand, right? As the supply goes up, the cost of it, or whatever you might want to call it, goes down, which is the interest rates associated with this particular pool. So that, I'm trying to shuffle some stuff around here. Okay, so we see that these red ones, that means the day started higher, opened at the top of the bold part of the candle. It may have traded upwards. We see this wick. Then it traded all the way down to a lowest point on this particular one where you see the wick at the bottom. And then it settled at the point of the bold at the bottom. Red means it was a down day, money leaving the market, people selling out of this particular security. So I have different lines here that we have. We have this channel that I've drawn that shows a downward movement trading within a range where traders were selling at a certain point, selling at the high, buy at the low. We also have other points that have been illustrated here, various different places where I'll get that information, Fibonacci levels, other levels of support showing from other trading history where it's bounced off of the point, meaning there is the point here where the market will signal certain things to those who are trading in this to buy or sell at certain points with this. These lines become ceilings where it will bounce off of it. They will sell at those points. They'll have sell orders placed. Or when the market is above it, it will be a floor of support where there'll be buy orders placed at that point. Now, interesting thing here, it charged up to this line that I drew at 100.53. Why did I draw a line at 100.53? It charged up. Everybody's talking rates are getting better. They're screaming this all the way back since October. October was our worst point in the market for interest rates. October 23rd of this year, it rocketed up. And as of December 14th, it basically stopped rocketing up. That buying into it, with the market data coming in with respect to the economy. The worse the economy looks, the better this is. The better the economy looks, the worse this gets. So we had things happening that's pushing it a direction, because it started with the jobs report coming in and saying what jobs are really looking like. They're looking a lot shittier than what they are. If you keep looking at the jobs report, they keep revising it. They put out the number to look better than it really is, revise it down. They finally start putting out reports that are actually close to the reality of it, and you can see what happened in the market. But it hit this point. What is this point that I'm talking about, 100.53? That 100.53 was the level that the market was at when they announced quantitative easing in November 25th of 2008. Pretty sure it was November 25th. Everything that they did before that, trading was below it. They announced quantitative easing, trading above that. Why trading above that? Because they knew the federal government was going to start throwing money into the security. Since they knew that was coming, everything jumped. And it stayed above that the entire time. So my guess, and this was a year ago, I started talking about this, or approximately a year ago, I went back and looked. And I thought, the market only traded to this extent until they announced this $8.9 trillion is what actually went into there. I don't know what their intention was at the time, but $8.9 trillion went into the markets. before they announce that, if that's to the max at trade, I don't think that it'll go above that convincingly unless the Federal Reserve puts more money in there. And look what it's doing. It's doing exactly as I said it would do. It keeps bouncing off it, bouncing off it, bouncing off it, bouncing off it until now we're at a level that was below. This was a level that you see this 99.83. That's a price where it was a floor that they would buy into. Now it got below that floor. We're dropping below that floor. Where's the next fall? 98.89. Guys, we're looking at nearly 100 points here in drop. It's a little bit less than 100 points, but that means the cost of the rates will go up 1 full percent, $1,000 for every $100,000 in loan. The reason I talk about this is because there's too damn many people telling me, they're saying the rates are going to go down. I'm going to wait till the rates go down. Keep waiting. You keep waiting, you're at huge risk. And what happens when the rates go down? Prices go up. People keep talking about potential crash happening. I believe it could be a crash up, meaning that things come so cheap again, if rates do go down, if they truly do, the Fed chooses to do this and it impacts interest rates, and we have this domino effect, the interest rates go down here, what you're going to have is a cost of everything going up. The average person, if you are a person right now that is trying to get into the real estate game, you're like, I'm going to hold out to the rates, you're going to pay more for the house. Period. You are right now setting yourself up for problems. Take advantage of it now. Quit your freaking waiting. Get in the damn game. I don't think it's going to get better. This comes from a perspective of a person that's been doing this since 1997, not a guy that you're talking to down the street who's been in loans for the last 5-6 years. These guys don't know what the hell they're talking about. If they have not been in this since the crash, I've been in it since 97. I went through the crash. I went through the dot-com crash. I went through all these others. I've seen these cycles. We're not in a cycle. There's manipulation going on. I need you guys to quit listening to the idiots that just want you to close with them. There's a lot more going on here. And if you're listening to those guys, anybody but me, I'm going to be a little biased on this one. You're putting yourself at risk. These other guys don't give a shit. They're going to quote rates and try to be the cheapest guy, and that's it. They don't understand this stuff at all. I do this because I need you to understand it, because if you don't, you're going to get yourself hurt. Call me. You got my number. You got my email. You got my subscription here, right? Just text me, 602-291-3357, 602-291-3357. Let's get you going. If you're waiting for rates, you're watching rates, or you're thinking they're going to get better, I'm afraid they're not. I really don't think they are. But they could. Unfortunately, I got to throw that disclaimer. I don't know. We really don't know. But everything's telling me we got to wait till the Fed does something significant. And I don't think they're going to lower the way we think they're going to lower this year. So mark my words on that one. If I'm wrong, I'm wrong. I'll admit it. But I think you're putting yourself in a bad position if you wait, period. Because if you do and the rates still go down, everything you're going to pay for is going to go up in price, and you're going to lose the value that rate gave you anyway. Talk to you on Tuesday.